Welcome back to a new episode where we tackle a question many are pondering as we head into 2025. With the looming possibility of a recession, what's the best move for your money? Pay down your mortgage, invest in stocks, or hold tight to your cash?
Yeah, it's a question we get a lot these days, and it's understandable, right, given the economic uncertainty.
Absolutely. We've got some great insights to share based on the research you provided. It really dives into the pros and cons of each option to help everyone make the best decision for their situation.
Right, because there's no one-size-fits-all answer here. It really depends on your individual circumstances, risk tolerance, financial goals, all of that.
Okay, so to make sure we're all on the same page, let's quickly summarize those three options. Pay off the mortgage, invest in stocks, or hold cash.
Sure. So paying off your mortgage, well, that's the dream for many, right? No more monthly payments. It provides a sense of financial security, especially when the economy feels a bit shaky.
And it's not just about the feeling. It actually gives you a guaranteed return in a way, doesn't it?
Exactly. Think of it like this. If your mortgage interest rate is, let's say, 4%, paying off your mortgage is essentially like getting a guaranteed 4% return on that money. Risk-free.
I see. So you're essentially locking in that return, which can be appealing when other investments feel unpredictable.
Precisely. And that peace of mind can be invaluable for some, especially as they get closer to retirement or if they're just naturally risk-averse.
But I imagine there are some downsides to consider too, right? There's no such thing as a free lunch.
You're right. One potential downside is that you might miss out on higher returns you could potentially get from investing in the stock market. Historically, stocks have returned somewhere between 7% to 10% annually.
So that's a significant difference compared to that guaranteed 4% from paying off the mortgage.
It is. And another thing to think about is liquidity. When you put a large chunk of money into paying off your home, you're essentially tying up those funds. They're not as easily accessible if you suddenly need cash for an emergency or a big unexpected expense.
That's a really good point. So you have to weigh the peace of mind against the potential opportunity cost and the reduced liquidity.
Exactly. It's all about finding the right balance for your situation.
Okay, so we've talked about the allure of a guaranteed return and the security of being mortgage-free. But what about those who are looking for higher growth potential? That's where investing in the stock market comes in, right?
That's right. Historically speaking, the stock market has been a powerful engine for building wealth. It's where you can see those potentially higher returns we were talking about. But of course, it comes with its own set of risks.
And we'd be remiss not to address the elephant in the room. The stock market can be volatile, especially when economic storm clouds are gathering, like we're seeing now with the possibility of a recession in 2025.
Absolutely. And that's where things get tricky. Investing in stocks requires a certain mindset. You need to have a long-term perspective and the ability to ride out those inevitable market dips without panicking.
So you're saying it's not just about picking the right stocks, it's also about having the right temperament.
You got it. Emotional decisions driven by fear or greed can lead to costly mistakes. It's about staying focused on your long-term goals and not getting spooked by short-term fluctuations.
So discipline and patience are key when it comes to investing.
Absolutely. And understanding your own risk tolerance. Some people are comfortable with more volatility, while others prefer a more conservative approach.
Okay, so investing in stocks has the potential for higher returns, but it comes with the inherent risk of market volatility. Now, what about that play it safe option of holding on to cash?
Well, holding cash is all about prioritizing stability and liquidity. You're essentially eliminating the risk of market losses and ensuring you have those funds readily available if you need them.
It's like having a financial safety net.
Exactly. And it can be particularly appealing when there's a lot of uncertainty in the air, you're not exposed to those market swings, and you have the flexibility to make strategic moves when the time is right.
So, for example, if the market does take a downturn, you'd be in a good position to buy stocks at a lower price, or perhaps take advantage of other opportunities that arise.
Right. It's about having options and being prepared. But, like any strategy, holding a significant amount of cash also has its drawbacks.
That's what I was thinking. It might feel safe, but doesn't it come at a cost?
It does. The biggest downside is inflation. As prices rise, the purchasing power of your cash erodes, meaning you can buy less with the same amount of money over time.
So it's like your money is slowly losing value even though you're not spending it.
Exactly. And of course, cash typically generates very low returns, if any, compared to investments or even paying off debt.
So while holding cash offers stability and liquidity, it's essential to be mindful of the potential downsides.
Precisely. There are trade-offs to consider with every option.
All right, so we've laid out the three main options: paying off your mortgage, investing in stocks and holding cash, each with its own set of advantages and disadvantages. But as we're heading into 2025, what are some key factors people should be paying attention to?
Well, one crucial factor right now is the interest rate environment. Interest rates are still relatively high, which makes paying off debt, particularly high interest debt, more attractive than it has been in recent years.
So if you've got credit card debt or other loans with high interest rates, tackling those might be a smart move right now.
Absolutely. And it's also important to keep an eye on those economic indicators we talked about earlier. Things like unemployment rates, GDP growth, and central bank policies. These can provide valuable clues about the potential severity and duration of a recession if one does occur.
So basically, stay informed and be prepared to adjust your financial strategies as needed.
You got it.
I know we've thrown a lot of information out there, but I think the most important takeaway here is that the absolute best path forward depends entirely on your individual circumstances, your financial goals, your risk tolerance, and your time horizon.
I completely agree. There's no magic formula.
It's all about personalization, tailoring your strategy to what makes the most sense for you.
Absolutely. For example, someone nearing retirement might prioritize paying down debt or shifting towards safer investments to protect their nest egg, while someone younger with a longer time horizon might be more comfortable taking on more risk with stock investments to capitalize on that long-term growth potential.
That makes sense. So how can our listeners start to figure out what the right balance might be for them?
A great place to start is by honestly assessing your current financial situation. Where do you stand with your debt levels? What are your short-term and long-term financial goals? How comfortable are you with taking risks?
And if you're feeling overwhelmed or unsure, it's always a good idea to consult with a financial advisor.
Absolutely. They can provide personalized guidance and help you develop a plan that aligns with your unique needs and goals.
Well, I don't know about you, but I'm feeling a lot more informed about navigating these tricky financial waters as we head into 2025.
Me too. And I hope our listeners are feeling the same way. Knowledge is power, especially when it comes to making sound financial decisions.
So it sounds like a balanced approach might be the key for a lot of people, especially in a potentially volatile economic environment.
Yeah, I think that's a good way to put it. It's about spreading your risk and diversifying your financial strategy.
So for some, that might mean paying down high-interest debt first, then making sure they have a healthy cash reserve for emergencies, and still allocating some funds towards investments for long-term growth.
Exactly. It's like building a strong financial foundation. You're addressing your immediate needs, protecting yourself from unexpected events, and still positioning yourself for future growth.
And it's not a set it and forget it kind of thing, right?
Right.
Our financial plans need to be revisited and adjusted as our lives change.
Absolutely. Your financial plan should evolve with you. Think of it as a living document that you update and refine as your circumstances change, your goals shift, and the economic landscape evolves.
So it's about being adaptable and proactive.
Precisely. Life throws curveballs, and your financial circumstances can change, so it's crucial to be able to adjust your plan accordingly.
So as we head into 2025 and beyond, what's the one piece of advice you'd leave our listeners with?
I'd say think of your financial journey as a marathon, not a sprint. Make informed decisions, stay disciplined, and focus on strategically positioning yourself for success, whatever the future holds.
That's great advice. I think sometimes we get caught up in the short-term noise and lose sight of the long-term goals.
It's easy to do, especially with all the information and opinions flying around, but having a clear plan and sticking to it can make a huge difference.
Well, I feel like I've learned a lot today. It's definitely given me some things to think about as I plan for my own financial future.
I'm glad to hear that. Remember, knowledge is power, especially when it comes to making sound financial decisions.
So it sounds like you're saying that even with a possible recession, looming, we shouldn't necessarily hit the panic button.
Yeah, right. That's right. It's important to remember that recessions are a normal part of the economic cycle. They've happened before and they'll happen again. The key is to be prepared, not paralyzed.
So instead of making drastic changes based on fear, we should really focus on sticking to our long-term plan and just making small adjustments as needed.
Exactly. And remember that recessions can also create opportunities. If you're in a position to do so, a downturn could be a good time to invest in stocks at a lower price.
That's a really interesting point. It's easy to just get caught up in all the negative headlines, but there's often a flip side to consider.
Absolutely. It's all about perspective and being able to see the bigger picture.
So I guess the main takeaway for our listeners is that, while the economic outlook might be uncertain, there are definitely steps they can take to feel more confident and secure about their financial future.
I couldn't agree more. It's about taking control of your finances and making informed decisions that align with your goals and risk tolerance.
Well said. And on that note, I think it's time to wrap up this episode. Thank you so much for sharing your insights and helping us, navigate these complex financial waters.
It's been my pleasure.
And to our listeners, thank you for joining us on this journey. We hope you found this conversation informative and empowering. And remember, knowledge is power. We're all in this together.
Until next time.
Take care, everyone.